We've all heard and have probably experienced that your mind can be the deciding factor in your trading success or your failure. And some will go as far as saying that the edge you really have is yourself, regardless of your trading system. So does that sound far-fetched? Well, not really. There are quite a few instances where the same method and same instructions were given to a group of people, but the results were varied. Now that should give you pause to think that if you have a positive expectancy trading method and you are not finding success, that the issue just might be you. How you look at losing trades, winning trades, and even missing trades can sometimes make the difference between long-term success or failure. Now once you believe that trading success is in large part dictated by how you think and act, you can start taking steps to address that. Now that's not to say that the method's not important, because it certainly is, but even if you give a group of people the holy grail, most will still not be successful. Now there are simple things that you can do to help combat the many psychological issues that arise when trading. One extremely important one is to have faith in your trading system that in the end, after a steady stream of trades, the positive expectancy will deliver an upsloping equity curve. So to put it in a different perspective, let's take a look at a driving analogy. You know where you want to go, and your GPS gives you precise directions to get there. It's the same route that you've taken many times in the past, and even though you've arrived later due to traffic, you eventually do meet your destination. Now, what if during a busy weekend you decide to venture off the proven track due to congestion and you decide just to wing it? Not only that, but so sure that you knew your direction, you decide to leave the GPS at home because, after all, you've traveled it so many times before. Well, that's what many traders do. They don't get the results they want, and in their impatience, they start veering off the course into uncharted water. It rarely turns out well as they drain their capital and they have to leave trading in the rear view mirror. They lose faith in their trading system and they start doing things outside of the scope of the tested trade plan that they've been following. Now, some rectify this issue quite quickly and can salvage their capital so that they can live to trade another day. Others, though, are not so fortunate. Having a trade plan is a given, and while most know they should have one, many don't. That's simply people not being prepared to treat trading as a professional career, and statistics say that most traders fail. And it's obvious why they do. Now I want to step outside the trade plan suggestion and dig into two things that you can look at that may make it easier to loosen the grip psychology has on our trading. Now you may have read that you should be definitive on your entry price and let price come to you. And for many people, they take this to mean they should use limit orders when looking to take a position in the market. Now this ignores that oftentimes getting the best price is not the most important part of your trading method. In fact, a popular saying goes something like, you make your money in the exits. You also save your money with the exits, because if you don't get out of a losing trade soon enough, you're going to watch your account tick away to nothing. The problem is that if you think an exact entry price is of the utmost importance, and you're going to make sure that you buy into an uptrend cheaply, you flip that for shorts, you may be adding a level of angst that will cause you issues in your trading. So let's find out how. So I'm going to assume that you already have a setup that you're looking at to actually have an entry price. In this example, I'm going to look at a support and resistance trader who places limit orders for the entry at the turns. So our trader noticed that the market was heading downwards, and after price turned back to the downside, the trader marked off an area of potential resistance. Now our trader calls it potential because you never really know if it's going to act that way in the future. The trade plan follows the trade the trend until it bends mantra, and given the state of the market and the potential resistance, the trader lays out a sell limit order. Now price rallies, but it doesn't quite hit the entry price until momentum slams price through the area that was called potential resistance. It also triggers the trader's sell order, and because the trader follows a standard stop placement just beyond resistance, the trade is taken as a loser. The good thing is this trader takes a loss as a part of doing business and quickly switches to a long side bias. Resistance turns to support is often said, although not always. So the trader places a buy limit order to take full advantage of the usual breakout pullback market action. Now price pulls back and misses the entry price by a small margin, takes off to the upside. Our trader is patient, and after seeing a topping candle, figures we could be looking at a double bottom playing out. Once price begins a complex correction, the trader is almost sure the buy limit will be active this time around. So price pulls up short of the AB equals CD pullback. It doesn't hit the potential support area, and then started off on a 15-point rally without this trader on board. So by attempting to get the best entry possible, this trader got hit with a double whammy. Number one, On the short side, this trader was fully involved in the loss as price blew right over the entry price and through the stop price. Number 2, on the buy side, this trader ended up sitting on the sidelines and missing the trade while price screamed off to a large 15-point rally. So the trader finally decided to alter the trade plan and use stop orders once price reached a zone of opportunity. Slippage could happen, of course, but because the trader only trades during times of high liquidity, barring any unusual event, slippage rarely occurs. The other benefit was that using a stop order now shows that price is attempting to head in the direction of the trade. While this tweak does not guarantee winning trades, it does ease the challenge of dealing with being executed into a trade and promptly getting stopped out. It also prevents you from seeing this quick loss compounded by a 15-point move that you don't take part in because you felt the entry price was key to being a winning trader. Now, the main drawback for people is that price is moving away from your setup area and will result in a larger stop distance, which ends up in a smaller position size. It's a trade-off, but for my money, I think it's a worthy one. Taking the dollars out of wins and losses. Now, this trading tweak comes from the idea of hiding your P&L, although this is not the tweak I'm going to talk about until after the session is complete. So why is that a good idea? Seeing the ticking up and down of a dollar figure can cause havoc with the trading mind. Think about seeing your position up 500 and down 300. The constant wave of your profit amount can cause traders to exit out of a trade because of the difficulty of dealing with that. What's worse is when you attach something significant to a losing trade. Imagine taking a $1,500 loss and then saying that you just lost the equivalent of your mortgage payment. And that's tough stuff. This tweak is actually from Van Tharp, who encouraged taking the dollars out of wins and losses and looking at them in terms of the R, the risk in a trade. While Van Tharp looks at this in terms of measuring the expectancy of your system, I want to look at it as keeping your sanity. And to do that, let's go back to our hypothetical trade from earlier. Now, our trader knows the zone of interest, and when price comes close to the area, he looks for a resumption of the previous move. In this case, once price stalls at the zone and forms a small trading range, the trader looks to sell the break as seen on this green dashed line. The stop goes above the zone with the red dotted line. Sticking to position sizing rules of a percentage of account, the risk on this trade is 3 points, $150. But our trader simply calls R. Price pokes below the range, takes the trader short, but the candle closes in what appears to be a test of the lows of the range, a failure test. This can be a sign that there is demand forming around this range, which may be pointing to a move to the upside. Now, our trader expects that a break the lows of a range on the underside of a resistance zone should see a continuation lower. Well, that didn't happen. So our trader moves the stop to just above the high of the test candle. Price rockets through and the trader books a $75 loss. Well, since the initial risk was $150, our trader actually booked a minus 0.5 R loss. So instead of using the dollar term, our trader sticks to the R designation because he's looking at his trading business in terms of risk and not money made and lost. Now, some may call it semantics, but how you label something has a direct impact on how it affects you. Think about it for a moment. Our trader was trading one contract in the ES, and to be honest, saying you booked a $75 loss may not mean much, especially if it's 1 to 2% of your capital. But what if your trading account was larger? Picture having a $100,000 trading account and you still risk 1% per trade. Your initial risk would be $1,000 and minus 0.5 R is $500. From a purely psychological standpoint, it's much easier to say that you lost $75 than it is to say $500, even though they still represent the same position sizing according to your account size. Is it a small thing? Sure it is, but it can make a world of difference to how you approach the losses that you're going to take. So our trader takes a break and comes back after the first move up and sees that price is in a complex correction stage. Price starts to hold near the bottom of the second leg of the correction, and our trader plays a breakout to the upside out of the small range that occurred. Now, a quick note about breakouts. I personally don't trade breakouts as a standalone method. Trading them as an entry inside of another pattern is my preferred method of breakouts. So our trader is fortunate enough to ride the full 15-point move and bangs a healthy $750 winner. Now, just saying that number gets our trader jacked up and ready for the next trade. Then he remembers the wins and losses are about the risk multiple. He quickly changes the winner in his logbook to 5R to signify that he made 5 times the risk amount. Now, you certainly want a trading method with an edge, but to leave your edge concern there is misguided. Trading is not just about the method you trade, but also how you process information, including your wins, your losses, and of course, opportunity missed. As traders, we want to make things as smooth as possible, especially when we know that how we think about trading can influence our decision-making process. Not having to deal with taking a loss without the slightest move in your direction is a positive in a business where you're going to lose at times. Barring an outlier event, you may be in a position to lessen the risk if and when price does move in your direction. Not using a dollar figure in describing wins and losses is without question a huge step in not being swayed by comparing the dollar figure to other financial responsibilities. Details matter, and although these are small trading tweaks, they can have a positive effect on your performance, and I challenge you to put these to use for the next month. Now see if you don't look at things a little differently in the end.